VWAP is a clear, practical way to read the market's intraday fair price and flow. It plots on your chart as the live average price where business has actually traded, weighted by volume. To use VWAP well, you need more than reacting to touches or crossovers. You need to know what it measures, how it updates through the session, and how a reclaim or a rejection defines risk and entry quality. In this lesson, part of our series, The Best Trading Indicators Explained Step by Step, we break VWAP down in plain English. You will see how it is calculated as cumulative price times volume divided by cumulative volume, how to add and clean it in TradingView, when to anchor it to a key event, and how to use optional bands to judge extension and mean reversion. We will also highlight the common mistakes traders make and how to avoid them. Less noise, more signal. A step-by-step breakdown you can apply today. Let's start by adding VWAP to your chart. In TradingView, open the Indicators menu and type VWAP into the search bar. You'll see two built-in options under the Technical section, Volume Weighted Average Price and VWAP Auto-Anchored. For this lesson, select the first one, Volume Weighted Average Price. That's the standard VWAP provided by TradingView, and it works straight out of the box. By default, VWAP is calculated from the start of the trading session, taking cumulative price times volume divided by cumulative volume. It automatically updates with each new bar as more trades occur. Once you've added VWAP to your chart, hover over its name and click the gear icon. This opens the Settings panel, where you can adjust both how VWAP is calculated and how it is displayed on your chart. Now let's walk through the full settings of the VWAP indicator. Starting with the Inputs tab. At the very top, we have the VWAP settings. The first option, Hide VWAP on 1D or above, lets you automatically remove VWAP when you're looking at daily charts or higher. Since VWAP is mainly used intraday, many traders like to keep this on. Next is Anchor Period. By default, it's set to Session, which means VWAP resets with each new trading day. You can also anchor it to a specific bar or event when you want to study a move from a certain point. Then we have Source. The default uses the typical price, which is high plus low plus close divided by 3, but you can change it to close, open, or other variations depending on your preference. Offset shifts the VWAP line up or down. Most traders leave this at 0. Now let's look at the band settings. Here you can add bands around VWAP, similar to standard deviations. In our case, we don't use bands, so we'll go ahead and remove this option to keep the chart clean and focused only on the VWAP line. Under Calculation, the time frame is set to chart, meaning VWAP adapts to whatever time frame you're currently using. And the option Wait for time frame closes. Make sure the values only confirm after each candle closes. That helps keep the line stable instead of moving mid-bar. Finally, under Input Values, you'll see Inputs in Status Line. Turning this on displays the VWAP settings and live values at the top of your chart. It's usually best to keep this enabled for quick reference. Now let's switch to the Style tab. Here you control how VWAP is displayed on the chart. At the top, there's a single checkbox to show or hide the VWAP line. Next to it, you can customize the color, the line thickness, and the style. By default, it's a solid blue line, but you can change it to match your charting template. Under Output Values, the Precision option sets how many decimal places VWAP will show. Leaving it on default is usually the best choice, since TradingView adjusts automatically depending on the asset you're analyzing. Finally, you have two simple but useful options. Labels on Price Scale adds a marker on the right-hand axis with the current VWAP value, and Values in Status Line shows the VWAP value in the top left corner of your chart for quick reference. For a clean and practical setup, it's a good idea to keep both of these options enabled. Finally, we have the Visibility tab. This tab controls which time frames VWAP will appear on. You'll see options for ticks, seconds, minutes, hours, days, weeks, and months. Each row lets you define the exact range, for example, from 1 to 60 minutes, or from 1 to 24 hours. If a box is checked, VWAP will be visible when that time frame is active. If it's unchecked, VWAP will be hidden during that range. At the very bottom, there's also a ranges option for more advanced visibility control. In most cases, you won't need to adjust this. With these settings in place, your VWAP is now fully customized and ready to use. In the next step, we'll focus on how to actually apply it in real trading situations. Now that we've gone over the default VWAP settings, let's take things one step further. To help you truly understand how VWAP works, we've built a custom panel that shows the full calculation directly on the chart. Instead of just plotting the final line, this version displays each step in detail, so you can see exactly how the value is built from raw price and volume data. The first step is to define the price source. We use the typical price, which is the average of the high, low, and close. By default, this is HLC3 in TradingView, but in our panel, you can choose the source yourself. The typical price is the foundation for everything that follows. Step 2 is to calculate PV. PV stands for price multiplied by volume on that bar. This is the building block for VWAP because it connects price to how much volume was traded. In step 3, we accumulate PV over time. We call this ComPV. The key detail here is that this accumulation resets whenever a new anchor period begins. You can anchor by session, week, month, quarter, or year. For example, with session anchoring, the reset happens at the start of each trading day. Step 4 is very similar, but instead of PV, we accumulate volume. This gives us ComV, the total traded volume since the start of the anchor period. Again, the reset occurs when the period changes. Finally, in step 5, we calculate the VWAP itself. It is simply ComPV divided by ComV. This gives us the average price, weighted by how much volume was traded at each level. If no volume is available, VWAP stays undefined to avoid false readings. On the chart, the line follows two simple preferences. You can apply an offset which shifts the VWAP forward without changing its value. And you can choose to hide VWAP on daily or higher time frames, since many traders prefer to use it primarily on intraday charts. This breakdown makes VWAP completely transparent. Instead of just seeing a line move, you now understand the mechanism behind it. You can connect every shift in VWAP to what price and volume are doing, and to how the anchor period shapes the average. For any trader who wants to go beyond simply following a signal and really master it, this kind of step-by-step panel is essential. Beyond the formula, let's pause and look at what VWAP actually shows us on the chart. At its core, VWAP is not about trend direction or momentum, it's about fairness. It plots the true average price of all transactions in a session, weighted by volume. In other words, it shows the level where most of the money has actually traded. When price is holding above VWAP, it means the majority of buyers are in profit and sentiment is leaning bullish. When price is stuck below VWAP, sellers have control and buyers are underwater. That simple relationship makes VWAP a natural dividing line for intraday structure. Institutions and algorithms use VWAP as a benchmark. For them, buying below VWAP means getting a good deal. Selling above VWAP means exiting at a premium. That's why price so often reacts around this line. It's the battleground of supply and demand. Another key point is how VWAP behaves through the day. Early on, it can swing quickly as volume builds. But as the session matures, it becomes more stable, acting like a magnet that price pulls back toward in range-bound conditions or a support and resistance guide in trending markets. Most traders only look for touches or crossovers, but the real insight comes from context. A slow drift back to VWAP after a strong move can show healthy trend continuation. A violent rejection from VWAP might reveal real imbalance between buyers and sellers. So every time price interacts with VWAP, whether it reclaims it, rejects it, or consolidates around it, it's not just a line on the chart. It's a snapshot of where the crowd has actually transacted and how the balance of power is shifting in real time. This is what makes VWAP so widely respected. With one glance, you can see whether the market is trading above or below the crowd's average price. And that perspective changes how you evaluate every setup. Now here's something crucial, and it needs to be said clearly. One of the biggest mistakes traders make with VWAP is treating every touch or crossover as an automatic buy or sell signal. They see price cross above VWAP and jump in long. Or they see it fall below and immediately short, without any context at all. That's not how VWAP is meant to be used. VWAP is not a crystal ball, it's a benchmark, a reference line that shows where most of the market has traded. Using it blindly, without considering trend, structure, or volume, is a recipe for bad decisions. Many traders lose money because they oversimplify. They go long above VWAP even when the move is already overextended. They sell below VWAP in the middle of a sideways range. That's not discipline. That's just chasing. To use VWAP effectively, you need context. You need to ask, is the market trending or chopping? Is this reclaim happening with volume or is it just noise? Is price consolidating around VWAP or rejecting it with force? When used properly, VWAP can be powerful. It works especially well when combined with price action, session structure, volume spikes, or higher time frame levels. That's how professionals use it, as part of a system, not as a standalone trigger. And that's the key point of this lesson. No matter what strategy you use, understanding the math, the logic, and the behavior behind VWAP is not optional. It's essential. And that brings us to something we'll repeat in every video of this series. Because truly understanding this one principle can change the way you trade. If you've already heard this message and it resonates with you, feel free to skip ahead. But we strongly encourage you to stick around and even replay it until you can repeat it by heart. This isn't just theory. It's the foundation of consistent, sustainable trading. Here's something every trader needs to hear, especially if you're just starting out. Indicators are not magical signals. They don't predict the future. They simply reflect what's already happened. They're tools, valuable ones, but still just tools. They help you read context, not control outcomes. The real problem begins when traders expect certainty. When they treat indicators as if they guarantee success. That mindset leads to frustration, disappointment, and an endless cycle of jumping from one strategy to another. To really understand why this happens and how to avoid it, let me share a powerful idea from Mark Douglas, one of the most respected voices in trading psychology. He once explained that many traders believe their system or indicator told them what was about to happen. But in reality, the market moves because of the conviction, or lack of it, between buyers and sellers, not because of any mathematical formula. He pointed out that most of the reasons we hear in financial news are just stories made up to sound logical after the fact. And this illusion of certainty is what makes traders feel betrayed by their systems, thinking the methodology failed them, when in fact, no technical method can predict what will happen next on a trade-by-trade basis. As Mark said, technical systems only tell you what's likely to happen over a series of trades, never the next single one. And just to show how unpredictable the market really is, Mark once told a story about a trader he mentored. This trader was an excellent analyst, one of the best Mark had ever met, but he struggled to execute trades successfully. So Mark advised him to focus on analysis instead of trading other people's money. The man followed his advice and became an analyst for a major firm at the Chicago Board of Trade. One day, the firm's chairman, an old-school grain trader, sat down with him. The chairman was skeptical about technical analysis and wanted to see how it worked. As they watched the soybean market move within a range, The analyst confidently said that the current price would be the low of the day. The chairman laughed, picked up the phone, and ordered the sale of 10 million beans, 2,000 contracts, instantly driving the price down 10 cents. Then he turned to the analyst and said, "If I can do that, anyone can." And that's the lesson. Sometimes it takes just one player with enough size or conviction to completely destroy your perfect setup. So, the next time you find yourself waiting for that perfect signal, remember this: it only takes one player with enough power to make your setup irrelevant. That's why mindset matters. That's why context matters. And that's why indicators, no matter how popular, are tools, not crystal balls. And that wraps up our breakdown of this indicator. In every episode of this series, we'll keep reinforcing the same core message. Indicators don't give you an edge. How you use them does. To help you move from theory to practice, check the card above and the description below. We've linked real strategies that use this indicator in action. And if you want to keep growing, take a look at our full training programs. We've got smart money concepts to help you understand how the big players move the market. Technical analysis for day traders, focused on fast, practical decision-making. The Wyckoff method, to help you read price and volume with structure. And most importantly, our complete trading psychology playlist, because no matter what strategy you use, mindset is what makes it work. Take the time to study. Focus on building real skill, not chasing shortcuts. Because at the end of the day, it's not the indicator that makes you profitable. It's how well you understand and use it. I hope you enjoyed today's video. If you found the content helpful or engaging, please give it a like, as this helps the video reach more traders like you. And don't forget to subscribe to the channel and turn on notifications so you never miss our latest insights on the markets and practical trading strategies. Sharing this video with your friends or on your social networks can make a big difference and helps our community become stronger. Now, if you want to go even deeper and get access to exclusive content, early video releases, and extra tools to support your journey, consider becoming a member of the ComLucro Trader community right here on YouTube. It's a way to support our work and a smart investment in your own development. Thanks for watching, and I'll see you in the next video.